Our case study is about advanced dew point analysis on Krispy Kreme donuts financial statement. Firstly, we reformat the company's 3 years balance sheet and statement of operations. We calculate the net operating assets, net financial assets, and comprehensive income, NOPAT, and the net financing expense after tax to get the figures to analysis. Then we use the advanced dew point ratios such as return on equity, operating return on asset, profit margin, and asset turnover to analyze. Overall, the return on equity slightly decreased in 2001 and then obviously increased in 2002. This change on the return of equity can be decomposed into 2 parts. The one is operating return on asset. The other one is the financing impact on return on equity. In terms of the operating return on asset, we can see that it rose over the 3 years, which is also can be decomposed into 2 parts, profit margin and asset turnover. The rising of the operating return on asset is mainly due to the increasing of the profit margin year by year, although the asset turnover declined during the 3 years. With regard to the financing impact on return on equity, we can see that the spread between the return from operations and the cost of financing increased to supporting the company's operating activities. The company was positive leveraged since 2001 because the company sold its net financing assets and utilized the financial leverage to support its operating activities. We can note that the levered was markedly decreased in 2002 due to the changing of its capital structure and the decreasing of its reducing debt financing. Next, my teammates will give us further analysis on profit margin and assets turnover.
Okay, next I will talk more about the assets operating return on assets, and we all know that this is an important measure of the core business of the companies, and in order to find out the real profitability of the company, and we have further decomposed operating return on assets. And as we all know that there's 2 components of the operating return on assets, right? The profit margin and the assets turnover. And as my teammate just explained, the profit margins rose year by year. And in order to find out why it rose year by year, so we have further calculated several ratios. And the important one is operating gross margin ratio. And after our calculation, we found that the gross margin ratio grew by 3% per year. And this is the key drivers for the profit margin growth. And also note that the general and admin expense also remained constant in 2000 and 2001, but in 2002 it also increased by 3%. What did it mean? It means that the company may spend more money to boost its sales, because if the sales goes up, and the general and admin expense will also goes up. So, and we also calculate some other expense ratio and the tax expense ratio, and here nothing special here because other expense ratio is mainly about the depreciation and amortization expense, and we found that it's remained constant. And also the tax expense although is increased year by year, but we know that the gross profit margin ratio goes up and the tax bill goes up as well. And we also instead for only looking through the core business of the profit margin, and we also calculate some operating items, other operating items, which is included in the other comprehensive income. And it is mainly about the equity loss and income and some minority interest, and we also found that it's remained constant. So in summary, we can conclude that the profit margin drivers is the gross profit margin ratio, which increased by 3% year by year. And next, we will come to the assets turnover, and in overall, the assets turnover is remained constant in 2000 and 2001, and then it declined in 2002. And as we all know that the assets turnover is relatively stable compared with the profit margin. So here we will focus on the reasons why it declined in 2002. And under the assets turnover, we have calculated the operating working capital turnover, and under this we also have choose some in material accounts like accounts receivable and inventory and we also look through the non-current assets, and particularly the plant, property, and equipment accounts. And after our calculation, we found that in 2002, the operating working capital declined dramatically, which means that the company became less efficient to manage its operating working capital. And we also found that the accounts receivable turnover also declined. However, the inventory turnover remains stable, and this means that the operating working capital turnover is some main drivers of the decline of the assets turnover. And besides, we also look at the non-current assets, and we found that the non-current assets turnover also declined in the 2002, and the PPE also declined. But however, it is worth to note that the accounts payable turnover also declined, which means that it can offset some negative impacts on the decline of the assets turnover drivers. So in summary, we found that the assets turnover is mainly driven by the operating working capital turnover. And that's all our advanced 2-point analysis of the Krispy Kreme donuts. Thanks for attention. Thank you.